Ladies and gentlemen, Asian guy here. In our last report, we looked at the smoking gun. We looked at the CFTC Bank Participation Report, the official government document that showed the U.S. banks flipping from short to long on the COMEX. It was a revelation. It was the signal we have been waiting for. But today, I have to tell you something that might keep you awake at night. I have to tell you that the report we analyzed, the report that every silver analyst obsess over, is essentially a fairy tale. It's not that the data is fake. It's that it is irrelevant. The COMEX, the futures market, the lit market, where you see the price of silver ticking up and down on your screen, that is just the tip of the iceberg. It is the part of the glacier sticking out above the water that you can see. But beneath the surface, down in the freezing, crushing depths of the ocean where the light doesn't reach, lies the rest of the ice. And it is 90% of the mass. This is the OTC market, the over-the-counter market, the dark market. If the COMEX is a puddle, the OTC market is the Pacific Ocean. And right now, there's a tsunami forming in the Pacific that is heading straight for the global financial coastline. We are talking about a market that is unregulated, opaque, and estimated to be 10 times larger than the visible futures exchange. We are talking about a $10 trillion secret that the banks have been hiding for 40 years. And today, we are going to shine a light into that darkness. You need to understand the difference between lit and dark. When you buy a stock on the NYSE or a futures contract on the COMEX, that is a lit trade. It goes through a centralized exchange. There is a record. There's a clearinghouse. There's a ticker tape. Everyone sees it. Regulators see it. The CFTC sees it. But when JP Morgan wants to make a deal with a massive hedge fund or a sovereign wealth fund or a tech giant like Apple, they don't go to the COMEX. They don't want to move the price. They don't want you to see what they are doing. So they pick up the phone, they open a private encrypted chat channel, and they write a contract directly between two parties, just me and you. No exchange, no cameras, no regulators. This is an OTC derivative. It can be a swap, it can be a forward, it can be an exotic option. And because it is private, they can write it for any amount, they can leverage it 100 to 1, they can rehypothecate the collateral. And crucially, they do not have to report it on the weekly CFTC commitment of Traders Report. This is why the banker flip on the COMEX is only half the story. Do you really think the smartest financial criminals in history would just openly flip their position on a public government report without handling their private business first? Of course not. The flip we saw on the COMEX was the victory lap. The real war was fought and won in the OTC market over the last 6 months. The US banks have been frantically scrubbing their private books. They have been unwinding trillions of dollars in toxic silver derivatives before the explosion happens. Let's talk about the scale. The Bank for International Settlements, BIS in Switzerland, is the central bank of central banks. They are the only ones who try to track this dark market. In their reports, they estimate the gross market value of OTC derivatives to be over $600 trillion. That is global. But the precious metals slice of that pie is massive. We are talking about paper silver that exceeds the physical supply, not by 100 to 1, but potentially by 500 to 1 or 1,000 to 1. Imagine a game of musical chairs. The COMEX is a game with 10 chairs and 11 people. We worry about that one person who won't get a seat. The OTC market is a game with 10 chairs and 10,000 people. And everyone has a contract that says, I own a chair. JP Morgan sold a chair to Hedge Fund A. Hedge Fund A sold a derivative of that chair to Pension Fund B. Pension Fund B swapped the risk of that chair with insurance company C. It is a web of lies built on a foundation of sand. Why does this matter now? Because of counterparty risk. In the lit market, if a trader goes bust, the exchange, the CME group, steps in and guarantees the trade. The system is protected. In the OTC market, there is no guarantee. If the entity on the other side of your bet goes bankrupt, you don't get paid. You get nothing. You get a lawsuit. And when the price of silver goes to $50, $70, $100, the entities on the wrong side of these OTC bets are going to evaporate. The US banks know this. They built this system. They designed the casino. And for 40 years, they used the OTC market to suppress the price. When physical demand was high, they would issue billions in unallocated silver swaps in London. This flooded the dark market with supply, which eventually leaked into the lit market and crushed the price. It was the perfect crime because there was no fingerprint. But now the mechanism is broken. The scrubbing I mentioned is the key. Before JP Morgan flipped long on the COMEX, they likely spent the last year calling up their OTC counterparties. They called the hedge funds. They called the family offices. They called the European banks. And they said, we want out. They used a process called novation to transfer their short exposure to someone else, or they simply bought back the swaps quietly, absorbing the loss or netting it out against other positions. This is the shadow deleveraging. And it explains the weird price action we saw in 2024 and 2025. Remember those days where silver would smash down for no reason and then rip higher for no reason? That was the whales fighting in the dark. That was the US banks violently exiting their OTC positions. They were shaking the cage to get out, and now that they are out, now that they have cleaned their private books, they are ready to let the whole thing burn. The $10 trillion secret is that the crash won't happen on the stock market first. It won't happen on the COMEX first. It will happen in the private ledgers of the shadow banking system. A major hedge fund, or a major family office, think Archegos Capital, but 10 times bigger, is sitting on a massive short silver position in the OTC market that they bought from the banks. When silver crosses $50, they get a margin call they cannot meet. But because it's OTC, nobody sees it coming. Suddenly, a fund liquidates $50 billion in stocks to pay for their silver losses. The stock market crashes. The pundits blame tech earnings or interest rates. But the real cause was a silver derivative in the dark market. This is the butterfly effect. A silver wing flaps in the OTC market, and a hurricane hits Wall Street. The danger we face today is that we are flying blind. We analyze the COMEX data like it's the Bible, but we are ignoring the devil in the details. The open interest on the COMEX is roughly 150,000 contracts. That represents about 750 million ounces. Big number, right? But in the London OTC market, billions of ounces are traded every day. The volume is astronomical. It is a churning ocean of paper promises. And here's the terrifying part, rehypothecation. In the OTC world, collateral is reused. Bank A posts collateral to Bank B. Bank B uses that same collateral to trade with Bank C. Bank C uses it with Bank D. It's a chain. If the price of silver spikes and Bank A demands their collateral back, the chain snaps. Bank B doesn't have it. Bank C doesn't have it. The money has been spent. The silver has been sold 10 times over. This is the definition of a Ponzi scheme. But it is a legal Ponzi scheme sanctioned by the ISDA, International Swaps and Derivatives Association. And the US banks have just pulled their money out of the scheme. They have left the building. They have left the foreign banks and the shadow banks holding the bag. So when we talk about a short squeeze, you need to expand your mind. And we aren't just squeezing the COMEX shorts. We are squeezing a $10 trillion shadow ecosystem that has leveraged the price of silver to infinity. When this thing blows, it won't just be a price spike. It will be a systemic reset of the global financial plumbing. The pipes are going to burst, and the sewage is going to flow everywhere. How do you hide a $10 trillion elephant? You don't put it in a room. You cut it into a million pieces and scatter it across the balance sheets of shell companies, offshore vehicles, and unsuspecting pension funds. This is the art of the scrub. And to understand why the silver market is primed for a nuclear explosion, you have to understand how the US banks managed to exit their toxic OTC positions without the world noticing. We established that the US banks flipped long on the public markets. But to do that, they first had to neutralize their private nightmares. You have to understand the timeline. This didn't happen overnight. This operation likely began in late 2023 or early 2024. The strategy was netting and innovation. These are boring legal terms that hide exciting crimes. Netting works like this. JP Morgan has a massive short position against hedge fund A, but they also have a massive long position against hedge fund B. In the OTC world, they can create complex total return swaps that effectively cancel out the risk on their own books, even if the contracts are still open. They spent months structuring these deals to make their net exposure look like zero to the Federal Reserve stress testers. They are masters of accounting magic. But novation is the real weapon. Novation is the act of replacing one party in a contract with another. Imagine JP Morgan is short 100 million ounces of silver in a swap deal with a German car manufacturer who wants to hedge their industrial costs. JP Morgan wants out. They don't want to buy back the swap because that would raise the price. So they call up a European bank, let's say Credit Suisse or Deutsche Bank, and they say, hey, we have this juicy contract. It pays a premium. Do you want to take it over? The European bank, hungry for yield and believing the silver is trash narrative, says yes. They sign the papers. JP Morgan steps out. The European bank steps in. The German car manufacturer doesn't care. They just want their hedge. But suddenly, the risk has transferred from New York to Frankfurt. The US bank has scrubbed the short from its books. They have passed the grenade to a partner who doesn't realize the pin has been pulled. This is why the BIS data is so confusing. If you look at the gross notional value of derivatives, it stays high. But if you look at who holds the hot potato, it has shifted. The US banks have effectively laundered their risk. They used the dark market to clean their hands. And they didn't just dump it on banks. They dumped it on the shadow banking sector. This is the wildest part of the OTC world. We are talking about special purpose vehicles, SPVs, set up in the Cayman Islands or Luxembourg. These are entities that exist solely to hold derivative bets. They are funded by private equity, by high net worth individuals, by dumb money. The U.S. banks packaged these silver short positions into structured notes. They sold them to wealth management clients as yield enhancement products. They told their clients, if silver stays below $30, you make 10% interest. If it goes above $30, you lose your principal. It sounded like a safe bet 2 years ago. Investors bought billions of dollars of these notes. They effectively sold insurance on the silver price to JP Morgan. Now, silver is skyrocketing. Those structured notes are blowing up. The investors in the Caymans are being wiped out. But JP Morgan? They are fine. They collected the premium, they offloaded the risk, and now they are buying physical silver with the profits. It is a transfer of wealth from the oblivious rich to the predatory elite. Let's look at the dark pools. Dark pools are private exchanges where institutions trade large blocks of securities away from the public eye. While usually associated with stocks, similar mechanisms exist for silver ETFs like SLV. The authorized participants, APs, use OTC derivatives to manipulate the flow of metal into and out of the ETFs. We suspect that during the scrubbing phase, the U.S. banks raided the SLV trust. They used complex swap agreements to convert their paper claims into physical metal, effectively draining the ETF to cover their own vaults, while replacing that metal with IOUs and unallocated credits. This explains why the SLV inventory looks stable on paper, but the market feels incredibly tight. The metal in the ETF might be encumbered, it might be leased out, it might be rehypothecated. The OTC market also allows for forward contracts. A forward is an agreement to buy or sell metal at a future date for a set price. The U.S. banks likely entered into massive long forwards bombed with mining companies. They went to the miners in Mexico and Peru and said, we will buy all your silver for the next 5 years at $35 an ounce. The miners, thinking $35 was a great price historically, signed the deals. This locked up future supply. It is an OTC coup. By the time the price hits $100, the banks have a contract to buy it at $35. They have cornered the production at the source using private contracts that nobody sees. This is why the miners aren't screaming with joy yet. Some of them are trapped in these hedging books. They are digging up gold and silver that already belongs to JP Morgan. The scrubbing was comprehensive. It was total. And it implies one thing: premeditation. You don't go to these lengths. You don't hire the armies of lawyers to draft these novation agreements. You don't structure these Cayman Island SPVs unless you know exactly what is coming. They knew the suppression game was ending. They knew the physical shortage was becoming critical. They looked at the internal data, the data we don't see. They saw the flows in the OTC market. The banks see who is buying. They saw the family offices in Asia buying. They saw the sovereign wealth funds in the Middle East buying. They realized that the whales were accumulating. And when the whales accumulate, the trend changes. So the U.S. banks did what they always do. They front-ran the trade. But because they were so short, they had to exit the burning building before they could watch it burn. The scrubbing was them sneaking out the back door while telling everyone else to stay for the party. Now, the building is on fire. The foreign banks and the shadow funds are trapped inside. The OTC contracts they signed are ironclad. There is no force majeure clause for bad judgment. They are legally obligated to pay up. And the U.S. banks are standing outside with the fire extinguishers, and they are refusing to turn them on. This is the reality of the $10 trillion secret. It's not just a number. It represents a web of deception that has been untangled by the architects and retangled around the necks of their victims. The real crash is the implosion of these private deals. And when they implode, the liquidity vacuum will be terrifying. We have talked about the scrub. Now let's talk about the bomb. In the world of OTC derivatives, not all contracts are created equal. Some are linear. If silver goes up $1, you lose $1. But the monsters of the dark market are the exotics. These are the complex, non-linear mathematical abominations that the banks created to gamble with insane leverage. And these are the weapons that will destroy the financial system when silver crosses the kill zone. The kill zone is $50. Why $50? Because of barrier options. In the OTC market, banks sell products called knockout options or knock-in options. Imagine a hedge fund bets that silver will stay below $50. The bank sells them an option that pays huge returns as long as silver is $49.99. But the millisecond, the price touches $50 or the option knocks out. It becomes worthless. Or worse, it converts into a massive short position. Trillions of dollars in notional value are structured around these psychological levels. $30, $50, $100. These are the cliffs. When the price approaches a cliff, the hedging becomes violent. This is called gamma. Gamma is the rate of change of the delta. In plain English, it means that as the price gets closer to the trigger point, the banks have to buy or sell exponentially more silver to hedge their risk. This creates a gamma squeeze. If the banks are short negative gamma in the OTC market, which they handed off to the foreigners, as silver rises to $50, they have to short more silver to stay hedged. They are forced to sell into a rising market. But eventually, the pressure becomes too great. They run out of ammo, the price breaks $50, and suddenly the knockout triggers. Boom, the hedge evaporates. The algorithm flips from short to panic buy. We are talking about computers programmed to buy billions of dollars of silver in nanoseconds to cover the exposure from a blown-up option chain. This is what causes a flash super spike. It's not humans buying. It's a mathematical formula executing a stop loss in the dark market. Let's talk about accumulators. This is a favorite product sold to industrial clients and wealthy Asians. An accumulator allows you to buy silver below the market price, as long as the price stays within a range. But if the price explodes, the accumulator turns toxic. The client suddenly owes the bank massive amounts of money. These products were nicknamed "I kill you later" during the 2008 crash. They are back. They are everywhere in the silver market. When these accumulators blow up, the victims, the factories, the rich investors, default. They walk away. Who is left holding the bag? The shadow banks, the intermediaries. And because this is OTC, there is no central clearinghouse to absorb the blow. In the lit market, the CME group has a default fund. In the OTC market, it is bilateral. It is mano a mano. If hedge fund X owes Credit Suisse $10 billion on a bad silver bet, and hedge fund X goes bankrupt, Credit Suisse takes a $10 billion hole in the chest. This is gap risk. The risk that the price moves so fast that you cannot liquidate the client before they go broke. And here is where the shadow banking system enters the nightmare. We have family offices and obscure private funds leveraging 50.1 or 100.1. They use total return swaps to hide their leverage. They put down $1 million and control $100 million of silver. If silver drops 1%, they are wiped out. But if silver rises 1% and they are short, they are wiped out. The volatility we are seeing now is the sound of these shadow funds exploding. Pop, pop, pop. Every time silver jumps $2, a dozen small funds die in the dark. Nobody reports it. Nobody cares. But eventually, a big one will die. A whale will die. So, we arrive at the final act. The tragedy of the commons. The moment where the math asserts its dominance over the narrative. We have exposed the dark market, the scrubbing, and the exotic bombs. Now, let's talk about the aftermath. What does the world look like when a $10 trillion derivative bubble bursts? We are heading toward the great unwinding. The unwinding is the process where the complex web of OTC contracts unravels. It starts with bifurcation. This is a concept every silver investor must internalize. Bifurcation means the splitting of reality. We will see the paper price on the screen, the price derived from these broken futures and OTC contracts, gyrating wildly. But then we will see the real price, the price to get physical metal in your hand. When the OTC market blows up, trust evaporates. No one will want a paper claim on silver. No one will want an unallocated account in London. Everyone will demand delivery. Give me the bar. But as we know, for every 500 paper claims, there is only one bar. 499 people are going to be disappointed. 499 contracts will have to be settled in cash. This leads to force majeure. This is a clause in every derivative contract that says, if an act of God or an uncontrollable event occurs, we don't have to fulfill the contract. The banks will declare the silver squeeze an act of God. They will say the market is broken. They will unilaterally tear up the contracts. Sorry, we can't give you the silver. Here's your money back at yesterday's closing price. This sounds like a solution, but it is actually the death knell for the fiat system. If you tell a pension fund or a sovereign nation, your contract is worthless, here is depreciating cash, they will panic. They will take that cash and immediately try to buy any real asset they can find. Gold, silver, land, commodities. This triggers hyperinflation in hard assets. The $10 trillion OTC market is essentially a suppression mechanism that kept liquidity out of the real world. It trapped money in a digital casino. When the casino burns down, the money floods out into the street. We are talking about trillions of dollars seeking a home in a physical market that is incredibly small. The silver market is tiny. If even 1% of the capital from the OTC derivatives market tries to enter physical silver, the price goes to 4 digits. This is the reset. The system resets by destroying the paper leverage. It clears the board. The losers, the shadow banks, the foreign bag holders, the unallocated account holders, are wiped out. Their wealth is transferred to the winners. Who are the winners? The entities holding unencumbered physical metal? The US banks who flipped long? And you, the individual stacker. This is why holding physical silver is the only true hedge against an OTC collapse. You don't have counterparty risk. You don't have a knockout barrier. You don't rely on a bank picking up the phone. You hold the asset. When the paper world burns, the value of the physical world is revealed. The real crash is off the books because the books are cooked. The banks keep two sets of books, the public ones and the private ones. The private ones are currently flashing red. They are screaming insolvency. The U.S. banks have managed to sanitize their own books just in time, but they cannot save the system. They have chosen to save themselves. What comes next is a period of extreme dislocation. You will hear stories of mines shutting down because they can't get financing due to the banking freeze. You will hear stories of refineries running 24/7 but having a 6-month backlog. You will see dealers offering buyback prices way above the spot price. The OTC market was the matrix. It was a simulation designed to make you believe silver was cheap. It was a digital illusion projected over a physical reality. The illusion is flickering. The code is corrupt. The glitch is the shortage. And soon the simulation will crash. And when it does, you will wake up in the desert of the real. And in the real world, silver is rare, silver is strategic, and silver is money. The $10 trillion secret is that the entire modern financial system is built on the assumption that they can print infinite paper claims. That assumption died the moment the U.S. banks flipped long. They admitted defeat. They admitted that they can no longer suppress the beach ball. So, what should you do? You should ignore the noise, ignore the volatility. When silver drops $2 in a morning, realize that it is just a dying gasp of a derivative contract blowing up in the dark. It is not real selling. It is forced liquidation. Use it. Buy the panic. Because once the dust settles, once the derivatives are washed away, the price will find its new equilibrium. And that equilibrium is multiples higher than where we are today. We are witnessing the end of the paper era, the era of unbacked promises, the era of the dark market. Sunlight is the best disinfectant, and the market is about to be flooded with the blinding light of truth. The truth that there isn't enough silver. The U.S. banks have made their move. They have exited the shadow. They have left the bomb ticking in the hands of their rivals. The countdown has started. The wires are cut. There is no stopping it now. The $10 trillion secret is out. And now that you know, you have a choice. You can stay in the paper world and hope for a bailout. Or you can hold the metal and become your own central bank. I'm Asian Guy. The crash is coming, but it won't be on the news until it's too late. Make sure you're on the right side of history. I'll see you on the other side of the reset.